Right, guys, this is episode 1 of teaching a dummy how to trade a complete newbie. I'm going to take him from zero to hero across the series. We're going to call it Easy FX. Now, let's get started with episode 1, which is the complete fundamentals, a complete introduction into trading and into the markets. So, tell us a little bit about yourself and your current trading experience.
My current trading experience is absolutely nothing, to be honest with you. I've seen a few trading videos online. I wanted to start it when I was younger, but I don't know, it just seemed way too complicated. But I'm always up for a challenge. But yeah.
Cool. Yeah, well, we're gonna help simplify it for you and help get you into the markets properly. So yeah, let's just start the complete foundation, which is what is a candlestick, understanding beginner price action. So I'm gonna go ahead and share my screen. We'll get started right here, bro.
Yeah.
All right. Can you see my screen right here?
I can see it.
All right, cool. So first and foremost, for all trading purposes, we always use this website right here, which is tradingview.com. So I recommend you go ahead and make an account. You can keep it as a free account. You don't really need the pro version quite yet. The only thing it really allows you to do is add alerts and stuff, which you won't be doing for a decent while. Cool. Okay. So when you first come here to TradingView, you want to make sure that your candlesticks right here is set on candles. You're not on bars, not on halos. You're just on the baseline candles. And it's the main form of data that we actually work with. Right. Now, these right here are called Japanese candlesticks.
Okay.
And it essentially just shows you what price is done and where price has been throughout a certain duration of time. Now, if you look up here to the top left, you'll see a bunch of these different timings. Now, these various time frames. So dependent on what time frame I'm on, it will change the way the chart looks, and it will change the way the candles print or the way the candles look. Now, dependent on the time frame that we're on, it changes the duration of the candle you're looking at. So right now we're on the 1 hour time frame, which means each candle represents 1 hour in time.
Okay, understood.
Again, if I were to zoom out, it would condense it all, etc. Still looking at the same bit of price action. It's just changing the way the candles are printing in front of you. Cool.
Okay, understood.
Now let's get into some basic terminology from Cool. So let me just expand this.
Question. I'm sure you was going to cover this, but what do you tend to, or does it vary? What do you tend to use in terms of time frame when you're trading a session?
Cool. So I'm gonna get into all the time frames and stuff we use in a minute as we get into market structure and stuff like that.
Right, sweet.
You want to start on a higher time frame and work your way down to find a higher probability position. I don't use all of these time frames, but we use a combination of 3 or 4 max. So we'll get into that.
All right. Sweet.
So it's a basic terminology. We have bullish, which means buy. Another word for that is long as well. So if you hear me referring to a long position, we're talking about buying, so the same thing. The inverse of that, we have bearish, and that is also referred to as a short.
Right. Okay. Yeah.
So I don't know why that's not expanding, but all right, solid. We'll leave it like that. Cool. So bullish, bearish, buy, sell, long, short.
Yeah.
Cool. Some other terms you might hear me say is a pip.
Okay.
Most people refer to this as a point. Now that's simply just a unit of measurement. Unit of measurement in the market. So if you are measuring height, you would use feet or meters or whatever. When we're talking about price action, we're talking about distance. We're using points or pips as the unit of measurement. Okay. Now, there's a very specific calculation for this, and it involves subtracting 2 numbers and looking at the decimal points and some BS like this. You don't need to be doing that. Everything nowadays is automated. So on TradingView, if you come here to the left-hand side and you go to this measure tool, a ruler, you click on that and you drag from one point to another, it will show you the amount of pips. And it will actually do the equation and stuff for you. So you don't actually need to know the maths behind it. You can always just use the measure tool.
Okay, that's
drag from 2 spots like this. Okay. Again, we're going to get into that and why it's relevant in a minute as we get into risk calculation, but just making it aware from now.
Okay, yeah, no, I have an understanding.
All right. So buy, sell, long, short, pip, point. Cool. Now moving into one final thing. We've got spread and slippage. Spread and slippage are 2 concepts that you'll be familiar with as you get into live trading and live execution. Spread refers to the difference of where you enter in at and where your broker enters you in at. So we're going to get into brokers and stuff here in a moment. It's kind of my next follow-up point. But the
Okay.
broker is the middleman between you and the markets, you and the liquidity provider. Because you don't have a crazy amount of capital to begin with and you're not trading hundreds of thousands, you can't actually execute trades directly to a live market. So you need a broker to be the middleman and actually execute the trades for you. Now, the broker is a business and they have to make money somehow. So the way that they typically make money is via one of two methods, either spread, which is you enter a trade. So let's say you click buy right here. And instead of being entered in right here, your broker enters you in like 2 pips above.
Ah,
So you're immediately in a little bit of a loss. And this little difference between here and here is the money that the broker takes.
okay. It's
So
interesting.
that's one method of the broker taking money off of you.
Okay.
The second method is just a simple commission. So you'll
Right.
actually get into them where you're meant to get into them at. And then when you close out your trade, they'll take a percentage of the profit. So generally speaking, if you have a good broker, you're looking for either a small spread and a slightly higher commission, or you're looking for a higher commission and a small spread. If you have a high commission and a high spread, you just have a shit broker. So
Right. Okay.
you're looking for one or the other.
Makes
Now,
sense.
in my personal opinion, I always much rather prefer high commission, low spread, but it depends to what extent the commission is, because once you start trading big funded accounts, 200, 300Ks, and your commission is like $400, $500 per position, it starts adding up real quick. You've taken 4 or 5 trades, and before you know, your commission sucked like a K and a half, and you're thinking, fuck, like that's taking quite a bit.
Yeah.
However, you also need to take into consideration that when it comes to measuring your risk to reward ratio, which is a concept we're going to get into in a minute, the spread can like substantially mess up your trade. And again, I know we haven't quite covered this, but we're kind of jumping ahead. If I was
No,
lining
but
up a trade, yeah, if I was lining up a trade that was a 1 to 2 risk to reward,
Yeah.
and that was my trade, and I come and I click enter, but then my broker enters me in up here.
Mm.
What I've done is I haven't actually entered a 1 to 2 because my entry's changed. I've actually entered a 1 to 1.3.
Yeah.
So it's like genuinely messed up my potential reward on the position, which is why I much rather prefer commission on trades.
Okay.
Cool, but we'll get into that as well.
No, yeah, that makes sense. That's what I was going to ask. Like, surely if they enter you later, then it can affect your overall trade.
100%. What you should actually be doing if you're trading with spread is you should be looking at the amount of spread you're going to experience, because on MetaTrader on the phone, I'm going to show you this in a minute, you can directly check what your spread will be. So what you're meant to be doing is if you have a position that's pending and you know that your spread is going to be like at least 3 pips or whatever, you take that into consideration when measuring your risk to reward. So you don't put it down there.
Yeah, no, understood.
Cool, blessed. Coming back to
Almost
this.
like a fucking, like when you're like sniping and there's like a drop.
Yeah, literally, it's just taking into account that a little bit of difference. Cool. Now, what we're going to get into right here is the basics of technical analysis. Sorry, zoom out this whiteboard because it's tweaking out. There must be a clear button somewhere. Yeah, sorry, never mind. Yeah, let's move.
Maro is sick though.
Again?
Maro, the thing that you're using is good to use.
It is. All right, cool. So beginner technical analysis. All right. Over the course of this, you're gonna realize how dyslexic I am with the spelling, so just allow it.
Bro, I'm the exact same, bro. I can't spell for shit. Like genuine, bro. I can't spell for shit.
No, for real. Right. So beginner technical analysis. Now, analysis is separated into like 3 subcategories. So you have technical analysis, and technical analysis is all about reading the chart, looking at price action, like just looking at all of this. You then have fundamental analysis.
Okay.
I also can't spell fundamental analysis. And that's all about looking at the news, looking at economics, looking at like those sort of.
Okay.
Cool. But it's annoying me how this is not in one straight line. I want it to extend.
Oh yeah, stretch it. You see it by the blue line.
That's not gonna.
No, not there.
This one.
Yeah. No. Yeah.
Okay, first. All right, love. All right, so we have fundamental analysis, which is looking at economics, looking at news, stuff of that nature. And then we have sentimental analysis.
Okay.
And sentimental analysis is all about understanding the psychology of other traders, understanding essentially the feel of the market. What are other
Right.
people likely to do? What are other people looking at? Is this a buy? Is this a sell? Like the psychology of the market.
Okay. Yeah. No, I get it. Okay.
Cool. So we're primarily focused on technical analysis. That's our main form of analyzing the market. We do also touch on fundamental. We're going to teach you about news using Forex Factory and stuff like this for economics.
Okay.
And then we use a little bit of sentimentals, always a factor, but generally
Mm.
speaking, we're mainly technical traders. So
Okay.
this
Cool.
is the primary factor we're focusing on. Cool. Now, the first bit of technical analysis we're going to be going through, and for me, this is the heart of any good trading strategy, and that is simple market structure. This is the baseline of literally any system. It's market structure. Cool.
Okay.
So what is a market structure? Market structure is essentially trend identification and just looking at highs and lows. That's the whole idea behind it. So we have two types of trends. We have an uptrend, we have a downtrend, and we also have a ranging market or a consolidation.
Yeah.
Do you know what any of these are?
Well, uptrend, of course, is when candlesticks are moving up. Downtrend is when it's moving down. And then ranging, I'm not sure. I assume that it's kind of when it's like just kind of stabilizing, and then consolidation is like lots of up and down in a line.
Yeah, essentially.
Sweet.
Pretty much. Cool.
Can't lie to you. I just guessed, just like
Yeah.
just general knowledge from how it sounds, isn't it?
100%, yeah. So the way to actually categorize an uptrend is you're looking for price to continuously make a higher high and a higher low, looking like this.
Okay.
So all these little blue points that you can see right here, these would be your points of structure. So as long as the high is higher than the previous high and the low is higher than the previous low, you're in an uptrend.
Okay.
So that's an uptrend. Downtrend, exact same concept, but just the inverse. You're looking for lower lows and lower highs looking like this.
Yep.
And then a ranging market or a consolidation is the same concept, but that's when price is failing to break highs or failing to create lows like this. Cool. Now, in a fairy tale world, price action would always be incredibly clean. You'd always have like perfect highs, perfect lows, and it'd be super obvious. But generally speaking, when you look at actual price action in a live market, you very rarely get price that looks like this. Again, it does happen from time to time. And as we get into trade selection and looking at the highest probability, like market opportunity, you'd be much better off looking for the higher probability trades that look like this. Generally speaking, you're not going to come across it. So let me introduce you to actual trade types or market types rather. Cool. So this is an uptrend. However, this is also an uptrend. Cool. So these are both uptrends. Price is still moving to the upside. It still starts down here. It still finishes up here. But on the one hand, you have very clean highs and very clean lows. And on the other hand, you have a bit of a madness. Now, if we're looking at every single one of these blue points as a high and a low, you're going to very quickly get confused because you're going to be like, okay, cool, we're in an uptrend, high, low, and then right here it fails to break that high and it breaks the low.
Yeah.
And it's all over the place, isn't it?
Okay.
So if you're too fixated on every high and every low, it's going to confuse you and you're just going to start bugging out.
Right.
So what we generally do when you're looking at price action like this is we look at what's called the swing high and the swing low.
Okay.
So what that is, swing high and the swing low, is essentially just the highest high you can see and the lowest low. So you're just looking at the most obvious points essentially. So in this
So like the main points which are sticking out and sticking down.
Yeah, exactly. So in this sort of scenario, I would identify that high and disregard the rest. Then we go to this low.
Right.
Then that high.
Okay.
Then this low.
Yep.
And that high.
Yep.
This low. So on and so forth, just looking at the most significant points.
Okay, understood.
Now, this would create up your market structure. And again, this is how you'd be identifying that you're still in an uptrend, generally speaking. Now, a good general rule of thumb for you to operate by is if you ever have to really sit there and look and try to understand, is it an uptrend, is it downtrend, you're just in a shit market because it should be relatively obvious. It should be pretty clear to you, yo, we're going up or yo, we're going down.
All right, cool. 2 seconds. Let me write that down.
Yeah, cool. Furthermore, for you people watching at home, same thing. Just if you really have to sit there and look and like try and understand what sort of market you're in, you're probably just in a bad market. Because generally speaking, the good high probability trading opportunities are going to be in markets that are high volume, that are trending, that are moving in one direction. And they're pretty obvious to spot, even for a child who like you'll hop on and be like, oh, this is going up. Let me go up. That's it. Cool.
Cool.
Nice. Now, again, same concept applies vice versa, just to make it clear. So obviously, same concept would be in a downtrend as well. Nice. Now, equally, a consolidation or a ranging market is when price is moving sideways and is failing to break highs and is failing to break lows like this. However, like we previously just discussed, generally speaking, the market's never 100% clean. So very rarely will you find price just create highs and just create lows in the exact same spot. It will usually do something a little bit more like this, for example.
Okay.
Now, again, if you were too zoomed in and you're not paying attention to the wider picture, you might be looking at this like, yo, we're in a little mini downtrend. It's a lower low, a lower high, lower low, high. Like you'll find little miniature uptrends and downtrends within a wider sideways moving price.
Right. No, I understand.
That's why you need to remember to zoom out a little bit and take into account context of what's happening in the wider picture and understand that, yo, this entire move has essentially just gone sideways. Like we've started up here, up here, and we kind of haven't really gone anywhere. So the general behavior that you're paying attention.
Yeah. So it's like no matter like if you're zoomed in at a certain point, there's always going to be like an uptrend or a downtrend or some bit of consolidation. But if you're too zoomed in, then you could mistake that as like to take action on it, but it's not.
Exactly, 100%. So, bro, if you go to any time frame, you're always going to find some sort of market structure. You're always going to find some little bit of volume where there's an uptrend, where there's a downtrend, where there might be a trading opportunity. And again, this is why it's so important for us to go through multiple time frames to confirm it on multiple bits of analysis, so you can actually confirm, okay, cool, what is the overall market telling me in contrast to what's this little bit of price action telling me. That makes sense.
No, it makes sense. Perfect sense.
Well, perfect. Let's continue.
But I'm learning so much already. Like genuinely.
That's good, bro. All right, now we're gonna continue to work off of market structure. Cool. Let's talk on solid market structure. We're gonna look at breaks of structure. I love how I spelled it 3 times. I still can't spell it. Lovely. We're looking at break of structure and changes of character.
Okay.
So these are just more fancy words for just market structure, essentially. What you're going to very quickly realize in trading is that there's like 6 million words to describe the exact same concept. A while back, people just started making up new terms just to describe the same bits of analysis, just to make it seem like they found new concepts, and it kind of stuck around. So there's a bunch of BS here.
No, in a way that I'm lucky that I'm coming in at this time because everybody's already been like through this whole like confusion, so I can just kind of take what is necessary.
Yeah, 100%. Bro, in my opinion, right now is like the best time it's ever been to start trading because there's such a large amount of information out there. Like the access you have to education, like free online on YouTube, on programs and courses. Like there's so much stuff. Like when I started, it was just babypips.com and like that one trading YouTube channel, and the dude was teaching that stocks as well. It wasn't even the same market, but like now like there's so many free like things out there. So
I think it's interesting how it's worked out. I've decided to come in now, but I'm happy about it.
Sick, bro. Let's get you funded, mate. That's the goal of my series, mate. Season finale, you get a fat payout.
Yeah, how we lit.
All right, cool. So this is what?
What's this? Is uptrend.
Yes. What's this?
That's a swing up.
Yeah, swing high. Yeah. What's that?
That's a swing low, a low swing.
Yeah.
Do you say swing and then low or low swing?
Yeah, cool. So I would say in this scenario, it's just a high and a low because we're not looking at like messy price. It's just
it's just a high and a low. Yeah, sweet. Okay, cool.
What's this right here?
Your point.
Yeah, well, it's just a higher high.
Oh, so right. Okay.
Just a higher high. Yeah.
Yeah.
What's this?
I say higher low.
Higher low. Correct. Cool. Nice. So that is the whole idea behind market structure. That's all it is. Higher highs and higher lows. That's the only thing you need to remember. Cool.
Okay, cool.
Now, what happens if we have a high, so a higher high,
Yes.
that then comes down and breaks the previous low? Well, this is referred to as a break of structure because we were previously in an uptrend. We're previously in the market that was making higher highs and higher lows.
Yeah.
And we had a move to the downside that broke the previous low. So this is called a BOS, or a break of structure.
Okay, makes sense. So it's like you're going to be looking at that and you're like, oh shit, maybe time to place in the trade, and then you're like, ah, fucked up the whole thing.
Yeah, essentially. So especially for the strategy that I'm going to be teaching you, which is primarily price action based, a break of structure or a BOS is one of the main factors you're looking at when it comes to entries or validating a trade or just looking at a general position. The break of structure is super important because it gives you a lot of information about where price wants to head. Cool.
Okay, makes sense. Can you give me 2 seconds? I just want to draw some stuff on the board so I can just label it. It'll literally take a minute.
That's cool, man.
So sideways is consolidation. Okay, obviously higher highs is uptrend.
Yep.
Then vice versa with downtrend. I mean, as in like lower lows. And then if this goes down, then that would be called a BOS. All right, yeah, cool.
All right, let's up. So yeah, this right here is a break of structure. Now, a break of structure should generally indicate the end of a trend. So you're in an uptrend, price has a break of structure. It's the end of an uptrend. You're now either looking for a accumulation or a downtrend to begin. That doesn't mean that price can't immediately have another upside movement. Like, there's no rules to this. The market can do whatever the market wants to do. But generally speaking, we're going based off of probabilities, and the next most likely movement is what we're looking at.
Right. Okay. Yeah.
Once price has had a break of structure, you're now anticipating that it's gonna have a move back up and then begin the downtrend. So a lower low, a lower high, lower low, so on and so forth, like this. Cool. Now, there's another concept which is called a change of character. Now, a change of character is literally the exact same thing as a break of structure. The only thing that changes is a change of character has to be in the opposite direction to the trend. So technically speaking, this example that I showed you right here is actually a change of character as well, because it's a break of structure in the opposite direction to where price is pushing. A break of structure, a BOS by itself, can be in the same direction. So you know how this is a high? If we were to draw a little level right here, as price comes up and breaks this high, like this movement, that is technically also a break of structure, but it's just Does that make sense?
Makes sense. But then can a BOS not be a positive thing as well?
Yeah, no, it can be positive. There's no negative or positive. It's just
cool. Information. It's just a bit of information. All right, yeah, cool.
Yeah, 100%. So a break of structure, same direction, change of character. It's just against where you're going.
All right, yeah, sweet.
Should actually be shock, change of character. That's the little acronym for it.
All right, sweet.
Cool. Blessed. Now let's expand into some key levels and some points of interest.
Okay.
I know we're moving pretty quick here, so if you need
bro, I'm keeping up. Genuinely, I'm keeping up.
Blessed. Cool. So we've got key levels. Now there's a bunch of key levels in trading. You got support, resistance, supply, demand, you've got order block, like you got a whole bunch of zones. And again, all these zones are just different variations off of the exact same concepts, whether or not it's ICT, smart money, or retail trading. It's all essentially the same shit. What I'm going to be teaching you is what I personally trade on the indices, and it's simple market structure based levels. But I'm also going to be teaching you how to just draw levels in general, because it's just a good skill to have. Of this, we'll just refer to it as support and resistance. It's the easiest terms to work with.
Okay, cool. Can you give me 2 seconds? I'm just gonna press record on my screen just so I can watch this back. I should have done it from the beginning, but yeah.
That's all good. Buddy.
Can I put, how did you do the record on here?
So I'm directly on Google Meet at the bottom. Regardless, I'm recording it. I can send you the Meet recording.
Oh yeah, that makes so much easier. Yeah, it makes so much more sense. Go ahead.
All right, cool. So yeah, I'm going to be teaching you first the basic model of support and resistance is the most common like terms for it, and then I'll show you how I actually use it and how we apply it to the system I'm teaching you.
Okay, cool.
So visualize price as a bouncy ball.
All right, then.
Support and resistance as a floor and a ceiling. So what happens if you throw a bouncy ball at the floor?
Well, it's gonna bounce back.
It's going to bounce
up and down.
You throw it at the ceiling, it's going to bounce back at the ceiling. If you throw it between two levels, it's going to bounce from level to level, like ping pong, pretty much. That's the idea behind support and resistance. Support is the floor, resistance is the roof, price bounces between the two. Now, the typical model, and this is what like the wider internet teaches, but it teaches that once you've seen price tap into an area 3 times, so once, twice, 3 times, on the 4th time that it taps in, you can then draw your key level and anticipate that price is going to hold it on the next one and start trading it. That's like the most common way to go about it. Personally, I don't really do that because the indices and what I'm teaching you to trade, they're very volatile. They're very like high volume. So generally, king price doesn't like to hold around levels for too long. So
the way, sorry to interject, but the way to think of support and resistance obviously is like the one that you showed me, but it's also kind of like the guidelines of your trade.
Yeah, you can definitely think about it like that. The guidelines of your trade. That's a way you can go about it. But don't think the price can't break these levels because it still can.
No. I understand, but as in like if in theory it should do what it's doing right now. You know what I mean?
Yeah, essentially, yeah.
So of course, I understand that the market can do whatever the fuck it wants. It's just like probable that could continue.
Yeah, essentially, bro. You're setting yourself a zone. You're setting yourself a range. You're like, okay, cool. Price is trading between this level and this level. Now, I want to trade from here to up here. That's my trading range. So if price happens to break down here, I don't want to be in the trade. Or if price comes back up here, I don't want to be in the position. So that's like your area.
Okay, understood. That cleared it up for me.
Yeah, generally speaking, there's a magic number of 3 in trading. You're always looking for 3 confirmation, 3 taps or whatever. That's the most typical model. Again, I personally don't really use that when it comes to the indices. But generally speaking, if you're looking at forex pairs, if you're looking at gold or silver or something like that, you would be probably waiting for like 2 to 3 taps before you can confirm some sort of zone.
Okay.
Now, a lot of places online will teach you to draw a key level as like a straight beam. So if you come here to TradingView, a lot of places will teach you to draw it as like a horizontal ray or some shit like this. But the problem with that is the market is never that accurate. Like you very rarely will have a couple of points tap directly in the same area. It's usually more like scattered like this, where you'll have a bunch of highs that are kind of in the same zone, but not quite. This is higher and that's lower and that's not quite at the same zone. So what you do is you come here to the brush tool and down to rectangle. I'd recommend you favorite it as well. So you can have it on the top bar. And then you just draw as a box, a general zone. Now, the box drawing and these levels is an art. It's like a skill set within itself.
Okay.
This meeting's going to end. I'm going to stop that and redo another one real quick.
All right, sweet.
Yeah, so the box drawing and this is a skill set within itself, and it's something you're going to get better at just through repetition. And again, I'm going to teach you how to do this on actual price action because it looks a little bit different when you're including bodies and wicks and stuff like that. But the key to the box drawing is you're trying to get that Goldilocks zone. What I mean by that is you can't have it too wham, because if it's too big, when you zoom into a smaller time frame, it's just going to be an absolute huge zone and you won't be able to do anything with it. It won't give you any real data. Equally, if you have your zone too small, it's going to start to confuse you because then you're going to have little points that break it. And then you might think, oh, maybe my zone's breaking. And then maybe I should be looking at something else. And it'll just confuse you. So there's like a midpoint that you want to be at, which we're going to get into. Cool. But that's essentially the idea behind support and resistance, the floor and the ceiling. Now, these levels are interchangeable. And when they break, it's called a role reversal. Now, it's not really too important of a term. I'll just throw it out there. And it's pretty self-explanatory. A role reversal is when one becomes the other. So let's say we're looking at this roof right here. We're looking at this resistance point, and price is tapped in 3 times, whatever. And then on the 4th time, it comes in and it just breaks it like this. So we've now broken a roof, or we've broken resistance. We then come back on the other side, and on this from this side, we tap back into this zone. Now, this zone that was previously resistance has now become support. So it's now acting like the floor, essentially. Now, because it's already tapped this 3 times on the other side, it's already a confirmed level. So I don't now have to wait for another 3 taps on this direction, because it's already confirmed beneath it. If that makes sense?
It does.
So an easier way to think about it is it's just a wall, and whatever side of the wall you're on is the side you're going to be respecting, is the general idea.
Okay. Makes sense.
Now,
so if we were trying to short, then we'd be going on the bottom one, essentially.
Yeah, literally. Yeah, literally what it is. Cool. Now, this right here is actually the baseline model for one of the most common trades that I take, and it's called a break and retest. Now, the break and retest. Sorry?
No, I was just a break and reset.
A break and retest.
Okay, cool.
So a break and retest, the simple model, one of the most common trades that I take in my trading strategy, and that is you're in a trending market. So right here, the idea is you'd be in an uptrend before you see this little section of price. Cool. So you're in an uptrending market. Price creates a key level, so it leaves like 3 highs or whatever, creates a key level in a trending market. It then breaks the level, comes back to the same level, gives you a nice retest at the level, and then once you get to the level, it will give you some other confirmations that we obviously haven't covered quite yet, and then it will give you that final change of character in your direction, and it indicates to you that it's now looking to continue to the upside.
Okay, I get it.
Is essentially that's one of the most common trades that we take.
That's right. All right, cool. So like obviously on easy, but when you're actually in the market, it's quite hard to identify, I assume.
Yeah. Yes and no. So obviously it is easier said than done. Generally speaking, it's a lot easier for me to draw a bunch of lines than it is to find the trade. But the whole idea behind this setup is it's meant to be like stupidly easy. It's meant to be one of the most like visual things for you to identify, because it's so obvious. It's so like, okay, level, break, retest, that's my trade. That's the whole idea.
Right. Okay. So mastering this, it can take you like very far.
100%, bro. Again, in my opinion, you don't need much past this point. That's why literally my whole system is virtually based around the break and retest, and everything else that I trade is just a slight different variation off of a break and retest. It's like the same idea, but just apply it differently.
Right. So like you're on the main road, and every now and again you take like a little like back alley, but at the end of the day you always come back to this one. You know what I mean?
Exactly. And if you wanted to, you don't even need to take any other roads. You could just chill on that main road.
Right. Makes sense.
So cool. That is the break and retest. Now coming back into some other key level stuff that we kind of glanced over. The main way that I actually draw my key levels is simply based off of market structure.
Okay, I'm just gonna draw a image of break and retest quick.
Yeah, that's cool.
One, 2, 3. Okay. Sweet.
Cool.
Yeah, let's go.
Blessed. Cool. So this is another way that I typically do my key levels, because a lot of the times when you're not in a market that is ranging, or when you're not in a market that's pulling back, you're not going to have key levels that are created off of multiple taps. So if you come onto like US 30 or NASDAQ or whatever, for example, and it's super high volume, you're likely to come across a section price that looks like this, where it's tapping and it's moving, but it's not giving you multiple taps in the same zone, because it's got too much volume, it's got too much momentum, so it's just moving very quickly. So in a sort of market like this, you're much better off using your market structure to draw your key levels. So what that means is it's pretty simple, but you just look at the previous high or the previous low that price left, and that would be your key level. So when you're in an uptrend, you generally use the highs first. So you see right here, that's the high. I'll go ahead and draw my box in, and the idea is that the next low will be in line with your previous high. See, that is kind of like a step up. So that's my high. Price comes back, retests, and leaves the low where the previous high was at. Same thing
Okay.
right here. You'd look at this high, you draw that zone in, and then the idea is the price will come back, retest here, and then continue that same
Yeah,
movement.
it's the same concept, just different velocity.
Yeah, literally, exact same thing, Now, obviously, in an ideal world, your zones would always hold, but that's not how the market works. Sometimes it's going to break. So the idea is that if I draw this high in right here, and then I wait for my retest, keyword being wait, you never take a trade based off of like anticipation, you wait for it to show you. So you come back and it taps in and then decides to break. Where's your second zone, where you simply just move this down to the low, which is also where the previous high was at, and that's your second zone. Now, in the event that this now breaks, what has now happened here?
BOS.
A BOS, yeah. Or even a change of character, same difference in it, but you've now had break of structure or a change of character, and you're now looking at potential reversal. So now at this point, once price has broken your structure and has broken your key level, you can do one or two things. You can either potentially wait for the retest here. Oh, so wait for the retest here and look for like the short move. Sorry, I'll wait for the short trade, or you can just leave the trade entirely. Generally speaking, what we do and what I teach my students to do is we're only trading in one direction. So if you're looking for a buy, you're only looking for a buy, which means that if price has a change of character and it comes against you, you're just out of the market. You're not doing anything.
Right. No, I think that's
sorry.
No, I was just thinking out loud. That's smart because like it's like then it's like I think it's psychological as well, isn't it?
Yeah,
It's like you're not changing like your goal.
For sure. Yeah, it definitely all comes down into psychology, and that's one of the main reasons I have this rule, is to kind of prevent you from doing some dumb trading shit. Because it's very easy for you to be looking at a trade, you're looking at a buy, price comes down, it breaks structure in the other direction. You're like, okay, now I'm looking for a sell. And then you take the sell here, and then price pulls this maneuver on you, and it comes back into your buy, and then you start spinning out. You're like, shit, I knew it was a buy. Let me hop back in on the buy, and then it breaks again.
And then you're just like in the fucking hole.
Yeah, you just start spinning out, bro, and you'd be surprised how quickly that can happen. And
I can imagine it. No, that's smart as fuck.
For sure. But that is the general concept right there. Cool.
Sweet.
Now swinging back round to the candlesticks, because we haven't actually put this.
2 seconds, just gonna write something down.
Cool.
Yeah, let's do it.
Swinging back around to the candlesticks, we have two types of candlesticks: bullish and bearish, or up and down. Now, for me, my bullish candlesticks are green and my bearish candlesticks are white. By default, on TradingView, yours will probably be red and green. I'd recommend changing them because they're very like emotional colors. We'll get into that at a later stage. But you're looking for something a little bit more neutral, but just have it whatever you kind of feel like having. Now, cool. What are candlesticks actually? How do we read them? What do they mean? Let's get into that right now. Cool. So we've got two types of candlesticks. We've got the bullish ones. Oh, drawing's about to be solid right here. Yeah, look at that. Crazy. Serious candlestick. All right, you got bullish candlesticks. And then we got the bearish candlesticks. Yeah, solid. All right, so the candlestick is separated into two main sections. You have this main section right here, which is the candle body. Yeah, this is horrid. All right, so you got the candle body. And the candle body shows you where prices opened and where it's closed. That's literally this main section is showing you the candle open and the candle close. Now, bear in mind, this is always going to be based off of a certain time interval. So it's always going to be based off of the time frame. It's really important you look at the time frame, because depending on what time frame you're looking at, it kind of determines how relevant that information is. We're going to get into that in a minute, but generally speaking, that easy rule of thumb is that the higher time frames control the smaller ones. So if you're on a higher time frame uptrend and you're in a lower time frame trend, you're still actually in an uptrend. It's just going to take a little minute for price to reflect that.
Okay.
Does that make sense?
Yeah, it does.
Cool. So On a bullish candlestick, let's say we're looking at a 1 hour time frame.
Yeah.
This bullish candlestick shows you that throughout the hour, we opened here and we closed there. That's the main information, the main takeaway. Now, these wicks or these lines either side, sorry, are called candle wicks. Now, the wicks show you where price has been, but has been unable to maintain. So I'll explain that in a moment. Let me just annotate this. So we've got the body open.
Cool. Just so I've got it clear, so like the candle body, right, is like that's the trades which have taken place within the time frame.
It's not about trades that have taken place, but it's just about what price is done.
Okay, all right, cool. Yeah, that makes sense.
Cool. So yeah, it just shows you the opening price and the closing price.
All right, cool. Within the time frame.
Within the time frame. So let's say this is 1 hour time frame. It's 8 a.m. At 8 a.m. price opened here, and at 9 p.m. At 9 a.m. it closed here.
Yeah, no, it makes sense.
Yeah. Now the wicks show you where price has been, but has been unable to maintain. So because we're looking at an hourly time frame, that means this is again an hour price action. Now we know where price opened and closed within that hour, but we don't know what price done during that hour. So the wicks kind of give you a little bit more insight into what has happened throughout this period of time. So cool. Let's say hypothetically at 8 a.m. we opened here where the body open is. Now throughout this period we fumbled about, we created some market structure, whatever. At some point in time we came the whole way down, which is what created this bottom wick. And then we continued, we done whatever, came the whole way up, which is what created that top wick. But ultimately we closed here. So you see right here, if you zoom in a little bit, you now get like a wider picture and more details into what actually happened within that candle. And that's essentially what the entire market does, is all that fractal. This is always happening within candles, and you keep zooming in. It's just, that's the whole market essentially.
Oh, that is crazy.
So that's what we're looking at right here. So whenever you look at a candle, you're just looking at literally a bunch of market structure just solidified like into one little bit. Does that make sense?
Yeah, no, that makes so much sense.
Now this is where it gets a little bit tricky, but now if you're looking at like, let's say this section of price action, and then you zoom into a smaller time frame, you can continuously zoom in and find more candles and more like market structure within it, and it just gets like super intricate. But yeah, cool. Get into that. Anyways, that's a bullish candle.
Yeah.
Bearish candle, exact same concept. The only thing that changes is your body opens at the top and it closes at the bottom, obviously because price has to go down. So it's the same thing, but just inverse.
Okay, right.
Cool. Makes sense?
It does.
Cool. Now, some other key information about the wicks right here is the wicks are super important for showing you behavior, for telling you what price wants to do. Now, if price is wicked to an area multiple times and you can see multiple wicks in the same zone, for example, right here, you see we've got 1, 2, 3 wicks and then 3 wicks here. That's an indication that something's happening at this area. So it can be an indication of a key zone. It can be an indication that price is failing to break. It's failing to create new market structure. It's like it's just holding some sort of area. So the wicks are super important when it comes to identifying key levels, when it comes to identifying behavior and momentum. And it just gives you a general idea of what price wants to do. Because if you're getting a bunch of wicks in one area, chances are price doesn't want to push there. And if it doesn't want to go in that direction, it's probably going to go in the other direction, is a general rule. Okay. So that's what you can kind of be doing with the wicks, just to get an idea of behavior. Now, when it comes to market structure, so if we're looking at this concept right here of market structure, in order for price to have a BOS or a break of structure, you need a body, a candle body, to close above another body. So it can't be a wick on a body, if that makes sense. So right here, if a body shut up here, in order for this to be an actual break of structure, the next body needs to close above this one. So if I give you an actual physical example, right here, again, I'm not entirely sure how clear it is because we had a bit of a weird period, but this would be a high. That's the low. And then in order for this high to break, we need this candle, so this body right here, to actually close above the previous one. So that right there would be the actual break of structure.
Makes sense.
All right, perfect, bro. Now, what we're going to go ahead and do right here, just so I don't overload you on this first sesh, is I'm just going to get you to quickly recap some concepts that we covered. So I'm
Perfect.
just going to ask you a couple of questions and just see that you have a clear understanding. I'll just go to GU for this, because why not?
Cool. Bro, genuinely, this is actually crazy. It's I don't even know how to describe it, but like the candle thing right there, yeah. Like before, they meant nothing to me, and now now I understand them. Do you know what I mean?
Yeah, it's crazy. It's crazy. Once you like wrap your head around the concept of like
Yeah.
looking at candles, it does. It's weird, isn't it? Because I remember when I first got into trading as well, and you look at candles, you'd be like, "What is going on here? Like, what are these? What are these colors?" And then you understand the concept of body open, close, and the wicks, and then
Yeah,
it starts to like you start to see it for what it's like, what it actually is.
definitely.
Stick man. All right, cool. I'm gonna ask you a couple of questions, bro.
Go ahead.
Let me just get this section up. Go remove drawings. As well, for all you people watching at home, let me know what you thought of the video. If you've made it this long into the video, shout out to you. You're clearly a G and you're clearly going to watch it up until the end. So I'd love for that. Let me know if you're enjoying the series. Let me know if you want me to continue this. I mean, I'm going to continue it anyway, but you might as well comment. So, all right.
Cool.
All right, my bro. What is going on right here? What's this?
It's overall, it's an uptrend.
Do you think it's an uptrend? Why is it not?
As in like from where it's gone down, do you mean as in like from the point of entry, or just like what is actually going on?
Just in this red box, what's going on? If I told you what's going on in this red box, if I asked you.
Um,
If you had to give it 1 of 3,
I don't know. If I had to give it 1 of 3, I'd say consolidation.
yeah, that is the correct answer. Would be consolidation. Yeah. To be fair, it was a little bit of a trick question right there. I set you off on a tricky one, but yeah, it's a consolidation. Again, the main thing I'm getting at right here is if there was no super easy buy sell for you, you're in a consolidation. Because you had to sit there and
Okay,
start actually looking and thinking you're in a consolidation. Because
right.
again,
Okay.
now
Yeah.
if I were to ask you,
Yeah.
if I were to ask you what's this, it'd be pretty clear. You'd say it immediately, and it's uptrend.
Yeah. Exactly.
Exactly. So again, if you have to deep it too much, probably bad price point.
Okay. Makes sense. Makes sense.
All right. What's going on right here? What's this section?
Overall downtrend.
Yeah, over downtrend. Yeah. Well, why do you hesitate right there?
No, I don't know. I didn't hesitate at all. Like I went to it straight away, but it's just like because I don't know. I was just like cautious of my answer.
Yeah. No, I hear you. Just calm down, don't deep it too much. You know?
All right, but I won't overthink it. I'll just like say what comes to mind straight away.
Just straight on it. All right. Cool.
All right, see.
All right. What's this section right here?
It's what from the that's overall consolidation because it's just like gone straight back to like where it began.
I would say it's an uptrend, bro.
Oh,
The
sorry,
reason,
I was looking at like from that point
yeah.
on your right to the left point. It's like kind of the same. Do you know what I mean? But fair enough.
Sorry, repeat that just so I can clarify what
No,
you're
I
saying.
don't know. Basically, you know how you said I was thinking in terms of what's it called? The walls. Remind
Yeah.
me. Yeah.
Or
Like the
resistance.
walls there, yeah. Like
Yeah.
they've overall it's gone back to the same level. But I guess that's because it's like in a huge time frame.
I mean, yeah and no. If we were looking at just this section here, I would be like, yeah, consolidation, like ranging market. But
Makes sense.
it's overall because we're in this wider section right here. If
Yeah.
we were to like get out this line, that would be the
Mhm.
high, that would be the low, high, low, high.
Right. Okay, yeah.
So we've
No,
still
I was,
actually made quite a significant movement, even though it took a little bit of a minute here in the center. It
yeah,
still
no,
took
makes sense.
a minute to
No,
move.
I was zooming out too far. That's why. But yeah.
Yeah,
All right,
that's
cool.
good. That's all. All right, cool. All right, what's this section right here?
Downtrend.
Downtrend. All right, easy. All right, let's zoom in a little bit. All right, what's this section right here, bro?
Downtrend.
Downtrend, correct. Nice. All right. Now, as we get into like lesson 2, session 2, we're going to go through a little bit more of like the difference between choppy price and clean price. Because
Right.
again, you can have an uptrend and a downtrend and have clean movements and like shitty movements, and it kind of differs depending on what you're looking at. So we're going to get into that, but also going to be covering the difference between an impulsive and a corrective movement. I think once I teach you that concept, it's going to click a little bit more. It's all going to kind of fit in together. For me, that's sort of the foundation of market structure and stuff like that.
Right.
But yeah, nice one, bro. I think we've made good progress here in this session.
No, 100%.
What I want you to go ahead and do for your homework and just kind of keep you moving along, and for you people at home as well, is in your own time, sit down on the chart, start looking at price action, and literally just sit here, come to the path tool. So if you go to this brush one here and you go to path, choose this one. Literally just sit here on your chart and just identify highs and lows, like actually draw it out, because sometimes seeing the physical line can like really help you conceptualize it, and just go high, low, and sort of operate like that. That's literally it, bro. So yeah, just get some experience. Again, it's all about getting repetition, especially in the initial stages. It's all about getting repetition. That's the main thing that's going to internalize it. You can sit here, we can do a 10-hour session about market structure, and if you can't actually do it yourself, it's not beneficial.
It's like training a muscle.
Exactly. So start training the muscle and getting some reps in there, and also start drawing a couple of key levels. Start identifying a couple of zones where you have like an accumulation of wicks, and grab your box tool and just draw from body, like try and encapsulate as many bodies as you can. So you see right here, where it's like a couple of bodies that are in line with each other. I'll just go ahead and start my box there. And I'll put the top of my box where I can line up some other bodies. So maybe like these 2 bodies right here, will line it up, and that will be my zone, for example. Again, just have a little experiment and just have a little play around with those sort of concepts right there.
100%.
All right, bless up, bro. I'm gonna stop the meeting recording right now.
Sweet, bro.
So yeah, for all you people at home, once again, thank you for watching the video. This is episode 1 of the Easy Effects series, teaching a dummy how to trade. Come back for episode 2, lesson 2, which will be in the next couple of days, and we'll kind of continue, and we'll get Sam right here funded and get you funded as well. Yes, sir. All right. Stop the meeting recording.